Am I recording?
Very, very awesome. All right. Hi, folks. Welcome. And I am super glad you're here. I'm going to make sure I can see your chats. And let's do this thing. Please throw in your symbols for me in the chat box. And I will take a look. In the meantime, I'm going to start looking at just the market in general. So it's been an interesting market lately. We've really grinded a whole bunch higher, and a lot of that, of course, as I think you know, has a great deal to do with the AI stocks, in particular NVIDIA, which has been taking up a bigger and bigger portion of the S&P 500. And so as goes NVIDIA, so goes the stock market. Today, NVIDIA is down just, 0.5%. That's not really relevant. But when we get those bigger moves over a percent or two or more, that ends up making a huge difference in the broad market. Okay. Another thing, of course, that is very relevant. There's a couple more things that are very relevant here. Obviously, the Fed, although that's taken a little bit more of a backseat, and the Fed is monitoring two things. They're looking at the inflation rate, and we're going to get our first signal of that this coming Friday when the market's closed, incidentally, that we've had in a while. When we see the PCE, a lot of people look at CPI and PPI, but the Fed cares much more about PCE. So we're going to be watching that. And the unemployment rate. Those are the Fed's two mandates. And they go back and forth a little bit on those two, depending on which one's feeling more urgent to watch. So we've had these little days, these past 4 days on pretty low volume. Like this is one of the lowest volume day. 4 days ago is one of the lowest volume days in the past 6 months. The day after that, the 22nd, was sort of an average volume day. Yesterday was the second lowest volume day we've had in 6 months. And well, today's today. We'll see. It's still early. So when we see a lot of this indecision, I mean, a lot of that is coming from the fact that there's just no news being driven this week. And because of that, we have no conviction from traders. What else do we need to know? Another thing. The VIX, which is sitting at 13 right now, is not like a rock bottom price. If we go to look at a chart of the VIX, and for those of you who are not super option centric, VIX, in a very important number, the VIX is what option traders look at when the rest, when regular stock traders are looking at, the S&P 500. Option traders, in addition to that, look at the VIX. And if we go back on a 10-year chart, we're sitting close to the bottom, but it's not really like a total bottom out where we've had in 2014, 15, a lot of 16, 17, 18, a lot of 19. We're not really at that complete bottom out level, but we're at a level that we haven't seen really for about 4 years. We're kind of sitting there on the monthly candle chart. So if we go back to our 6-month, which is my preferred chart setting, that's where we are. All right, so let's look at a couple of symbols here. So PFE. So PFE is an interesting one. Pfizer. So Pfizer, like a lot of drug stocks become interesting ones to watch. Like one that I've been watching for a while, Madrigal Pharmaceuticals, like they just got a really big non-alcoholic fatty liver drug approved. So before I get to Pfizer, I kind of want to go over an example of how I analyze drug company charts, MDGL. So this has been a really super interesting one to watch. I've been in and out of this one with the underlying shares as well as options for, well, I don't know, most of this time, probably about 4 months. Now, since this was like their first drug, if I'm not mistaken, clearly the biggest drug in their portfolio, a lot of the value of their stock, in fact, when drug companies have their first drug coming out, that is all their eggs in one basket, all their chips on the table. The entire value of their company is predicated on that drug getting approved by the FDA. And there's 4 stages in the trials, and this company made it through those trials. So a stock like this, where it's their first drug, has a great deal of risk. Now, I usually don't trade these, but I did a great deal of research on this drug and this disease. Definitely spent a lot of time talking with a friend of mine who also knows a lot about this disease and how helpful this drug could be. Led me to playing this where I typically don't play these kind of stocks. Now, okay, that being said, let's look at, from a drug company standpoint, the antithesis of that, Pfizer, who has just a massive portfolio of drugs comparatively. This trades more like a regular stock. Yes, when their products sell better, the company does better, and that's how it is with any other stock, but they don't have all their eggs in one basket. They have what we call in the business a portfolio of drugs. Okay, so that being said, we can definitely look at a company like this much more traditionally and much more technically. Oh, also, one of the reasons why I brought up Madrigal is because Pfizer is working on a drug that in some ways, not exactly head to head, but in some ways will compete with Madrigal's drug, which makes it very, very interesting. That is more from the standpoint of diabetes, weight loss, and such, which is related. All right, so, and again, I'm not a doctor, nor do I play one on TV, but hey, what the heck, I'm doing my best here. I'm just a guy who looks at stocks. Okay, so we're sitting here at the 50-day moving average. And in fact, I like to look at 3 simple moving averages at all points. And notably, I've got one missing. I like to look at the 21-day because that's a month, the 50-day, and the 200-day. So let me get my 200-day back up here, how it's supposed to be. All right. So now, when I'm trading as opposed to investing, I'm not holding anything for 200 trading days. I mean, that's almost a year. But it does act as a very strong support or resistance level. In this case, resistance, and we've got a ways before that resistance even hits again. But the 50-day moving average, which also I don't tend to hold positions for 50 trading days because that's about a quarter, less than a quarter, but more than 2 months. I typically don't hold trades that long, but that also acts as a huge support or resistance level. And it becomes an important one because as I'm looking here, and by the way, if you're wondering why I'm looking up like this, it's because my screen is sort of above eye level here. So I'm not like looking up at the sky for, airplanes or anything. Okay, so we've been bouncing around this 200-day moving average, and when we do that, when we have these consolidation periods, what we do is we look and we wait for a breakout. But these periods can last a while. Well, I mean, this one's only lasted like, I don't know, 2 weeks tops, whereas this one a little longer, maybe 3 weeks. This one was only about what we have going now before we get a little bit of a breakout from either direction. So from a technical standpoint, RSI, which is one of the things that I like to look at, I like to look at just the level of it. And I also like to look at divergences, which is not really relevant here. We're going to, from a technical standpoint, what we're going to be looking at is we're going to be looking at a clear breakout away from this 50-day moving average. Now, we're also going to be looking at the 21-day moving average crossing. If it does cross above the 50-day moving average, that can give us some momentum to the upside. That's a concept, conceptually related to how MACD works for people who look for signals from that. A little different because we're using different time horizons than that uses, but conceptually the same. It's a moving average crossover. So from that standpoint, when I see something like this, what I like to do is I like to say, is implied volatility cheap or expensive? Because if I'm looking for a breakout, the breakout could occur in either direction. Probably not likely to be a huge breakout, but when I think a breakout could occur in either direction, what I like to do is I like to look at a potential straddle. And 19 times out of 20, I'm not going to trade the straddle. It's not going to work out. But I look at it anyway, because when they do work out, they can work out pretty darn great. So, straddle. How do we analyze a straddle? Okay, so if I go back to the charts, I see that the historical volatility is 26 and change. So what I do is I look at the implied volatility, and if the implied volatility is trading below the historical volatility, especially on Thinkorswim, because they tend to over assert the implied volatility level, meaning their implied volatilities are a little bit higher than what the real implied volatility is because of the calculation they use, which is the same calculation the CBOE uses to calculate the VIX. We look at this and we say, the implied volatility is below the historical volatility, and to boot, this is overestimated anyway. Now, for those of you who are implied volatility aficionados or would like to be, there's another element at play here, which is really unique to this particular week. And that is the fact that the implied volatility, while it's overinflated because of how Thinkorswim does their calculations, it's also deflated because we have a shortened week today. The market is closed on this Friday, the Good Friday holiday. So it's a 3-day weekend. So time decay starts coming out of these options, which means that the model being used by any retail-based online trading platform can't account for it. It doesn't know when to move the days ahead and how many days to move it ahead. So it gives the falsity that the implied volatility is actually lower than it is. Where does all of this come from? Well, it ends up basically being a wash. Bottom line is implied volatility is pretty low. All right. Now, when we're even going to analyze a straddle, what do? Well, we start out looking at a longer term time horizon than we'd like to hold. Why? Because short-term options have high theta. We don't want to lose a lot of money overnight. So if we buy a longer term option, more time than we need, we can make money on a breakout while not paying as much time decay. So I like to look at like a month-long option, presuming that the bid-ask spreads are still tight, which in a stock like Pfizer, they're good enough for sure. So problem here is we're sitting right between two strikes if we use the 31-day option. So I'm actually going to go down to the 24-day option so I can use the 27.5 strike, which is sitting right smack dab or rooski at the money. And because that's a monthly, I get tighter bid-ask spreads. First of all, is everybody following me so far? I'm dumping a whole big brain dump of information on you. If you're not really an intermediate level option trader, if I'm going too fast, please follow up with questions. That's why I'm here. So, you know, yep is I'm doing good, or yep is Dan, slow the heck down. Good. Okay, awesome. Good. And anybody else, you know, if you need me to expand on anything, please let me know. I am here to serve you this morning. Okay, so let's model this puppy out. So I'm gonna do this, and I like to trade straddles pretty small because straddles are very, very tricky to trade. I'm just gonna model out about a 4 lot here. And this is what we end up with. Now, what I like to do is I like to set my slices to break even, to add expiration, break even. And basically, if we're using the at expiration break evens, which, by the way, we're going to be wanting out of this way before expiration. But this just gives me sort of a worst case scenario. My break evens are about, well, they're 26.18 and 28.82. So 26.18, and now I'm going to get rid of this 200-day moving average so that I can see a bigger space on the screen. Okay, so 26.18, it would have to go way down to here, which, just using the chart for some context, isn't crazy, but it's not one of those no-brainers where I think it's likely. And the other one was 26.80 or 28.82, another one in the realm of possibility, but not necessarily likely. So therefore, I am definitely not a fan of the straddle. What the heck are we able to trade here is probably what Saz is asking. And you know what? Today, right now, nothing. But what we're going to want to do is, this is a great one to monitor for two things. We've got to get something to hang our hat on, right? We don't just say, oh, I'll bet it'll go up or I'll bet it'll go down. We've got to get some sort of tangible signal that we can use. And there's only two things that we can use here. One, 21-day moving average crossing above the 50-day is going to give us a buy indicator or a positive delta indication, depending on how we want to play it. Your best bet is probably with a bull call spread because you'll risk the least and make the most. Or just simply the chart itself breaking out of this recent range. So basically somewhere above, you know, about 28.30 or below 26.78. And if we get that, in hindsight, a straddle would have been good, but there's not a whole bunch more to trade. I mean, the only other thing to trade, which I would be comfortable doing only on a very, very short-term time horizon, is to fade that move, which, until we get some sort of breakout, boy, I mean, we would literally have to break out of that range. Yeah, but you know what the thing is that when the implied volatility is already depressed, those income trades, you know, like a lot of people will say the only way to make money in options is to sell them. That's usually right, except in cases when the implied volatility is too cheap. So we're just going to have to forego this opportunity until we get some sort of a breakout. All right. So Saz, don't you hate when it leads to no trade? But you know what? Sometimes the best trade you can make is not making the trade at all. All right. Utred wants me to look at the old softy, MSFT, which is this one. So Microsoft is one of the AI stocks. Just bought myself a subscription to Copilot. We'll see how that ends up working out for me. which is one of their AI products. And I also subscribe to Chat GPT, the fourth, whatever it is, 4.0. Whenever my wife will say, hey, do you know what blah, blah, blah? And if I don't know the answer, I'll say, hold on, let me ask my friend. And I just ask Chat GPT. Okay, so anyway, Microsoft, obviously, and this is a result of it being so ingrained in, let's get our 200-day moving average back up here. So ingrained in, wait a second, hold on a second. I can't talk about one thing and type another thing at the same time. All right. We always need these up here to give us some context. Because Microsoft is so ingrained in AI, we see these higher highs. Oh, here's a couple actually lower highs. But then we're back to higher highs and higher lows. It's actually sort of a tie. We had a little bit of a breather here, but we're back to higher lows. So this is clearly the definition of an uptrend, especially when we see the moving averages, what we call stacked, where the longer term one is, we have the longest term, medium term, highest term. When they're stacked like that, that's another very clear indication of an uptrend, and we love being in uptrends like that. Okay, so how do we play something like this? Well, the first thing that I like to do being an options person is we have to look at implied volatility. Now, look, some people say, hey, look, Dan, like, why do you look at implied volatility? I mean, what's the difference? I mean, as long as we're on the right side of the correct side of the delta, does the implied volatility really matter? And the answer is yes, it really matters greatly. Now, it's a secondary consideration. If I'm going to place some positive delta play here and this goes up, I'm probably going to make money as long as it goes up fast enough to cover any theta associated with it. But what the implied volatility does is it helps me optimize that positive delta strategy. Should I be buying at the money calls, or should I be buying lower Vega and theta in the money calls? Or should I be hedging off my theta and Vega by doing a bull call spread? Or is the implied volatility so high that I'm better off doing a bull put spread, selling the at the money puts and buying an out of the money puts? When it comes to trading, here's the thing about trading. You're going to be right a lot and you're going to be wrong a lot. If you make 1,000 trades, that statement is universally true. If you haven't made 1,000 trades in your career yet, that statement might not make sense now, but it will after 1,000 trades. You're going to get some battle scars and you're going to get some glorious victories, right? So the specific way to trade an opportunity ends up becoming extremely important in the long run. We need to give ourselves the lowest risk, the highest reward, and the best chance of success. So that's why we have all these different option strategies, because now one is universally better. Each are better for different market setups, including and especially taking into account implied volatility. Now, there's a lot of folks talking about how the market may be overpriced and looking for a pullback. Here's the way I look at that. One of the first things that I want to do is I want to do this. We're going to go P/E ratio of S&P 500 today. And as of, here's the AI from Google's Bard up here, as of March 22nd, which is just a couple of days ago, the PE ratio is 28.89. Now, is that high or is that low? I am a big fan of Y charts. This is as of Q3 for 2023. Hold on a second. We got to get that updated. Current PE ratio. Let's get a chart here. Now let's see if Y charts. There we. Oh, this is the forward estimate. Oh, goodness gracious. How about this? We'll go back to this one. We'll go interactive charts. Oh, goodness gracious. Sometimes it's just a pain in the butt finding these charts. But here, I'll give you the punchline. The average is something much, much closer to about 23 or so. So we're sitting at a very high PE ratio overall in the broad market. So what that means, I mean, look, people who evaluate the stock market, looking to see if it's overpriced or underpriced, the PE ratio it's a very general category that consolidates a lot of information into a very simple number that a layperson can look at and say, oh, this is above the average, this is below the average. Since we're sitting pretty significantly above the average, that indicates that stocks in general are somewhat overvalued. Now, like I said, that is a very general figure that consolidates a lot of information because NVIDIA is taking up a higher proportion of the S&P 500 these days. That doesn't mean that all stocks are overvalued. It means that the total aggregate of what makes up the S&P 500 is overvalued, and that gives overweight to some stocks that are trading at very, very high multiples. Okay, so there's the market as a whole. How about Microsoft? Let's see what Microsoft's PE ratio is. PE ratio of MSFT today. This PE ratio of 38. That's a 17% increase from the average PE ratio of 32.6 over the past 4 quarters. So Microsoft might be a little ahead of its skis, as skiers say, as well. So could we be looking for a pullback? Yeah, well, you know what? Here's the thing. Yeah, we could. But the problem is that we never, even in overpriced scenarios, we never want to fade the tape. When we're in an uptrend, we don't want to, like near all-time highs, we don't want to start selling call credit spreads or anything. We don't want to start buying puts. We don't want to start taking those negative delta positions until we see somewhat of a pullback. Now, 6 points for the PE ratio to be, that's how far it is above the average. We've got some room to wait for some sign of a pullback. RSI is fine, not really overbought, but what we do see is almost a little bit of a divergence here. In fact, I can kind of call this a divergence. A divergence in the RSI is when we see a high in the RSI and up to this point, a high in the stock. And then we see another high in the stock that's a higher high and another high in the RSI that's actually a slightly lower high. So that is a bearish signal. Now it's not that much of a lower high, but it is a smidge, but it's not really enough for us to hang our hat on as well. The implied volatility looks to be probably roughly about fairly valued. It's pretty tough to buy a straddle here. Go out 30 days and we're paying about $23 for a straddle. So we'd have to move down to about 400 or 450 over the next month. 400 is where we've got support. 450 we've never seen before. There's really not too much to do in Microsoft as well. There's nothing. I mean, look, we can do some speculation. We can say, hey, I think this trend's going to continue. And if I had to play this, I would definitely play the continuation, even though the PE ratio says it's overvalued. Stocks can remain overvalued for long periods of time. For those of you who've been in trading or investing for more than 5 years, you know that. Especially if you've been in trading or investing for more than 10 years, you really appreciate that. But I don't know. I mean, you can't fight the tape. So until I see some sort of pullback, which I would not be very surprised to see at some point, there's nothing strategic to trade here. Okay, so Fred says, can you present any iron condors that you see viable? And yes, I can. In fact, what I'm going to do is I'm going to start with, before I even get to iron condors, what is an iron condor? An iron condor is 2 credit spreads, right? So I've devised something here. It's called Credit Spread Genius, and I've got a couple of variations of that, including Wing Spread Genius, which I'll show you in a minute. And what this does is it's a pretty clever little tool. Nobody else has this, by the way. I spent a lot of years working on the trading floor of the CBOE, and then I actually worked for the CBOE. They used to fly me around the world, having me teach professionals and non-professionals option trading, as well as members of the SEC, the Congress. Who else? I don't know. They used to fly me all over teaching options, and I've just collaborated with them for years and years since then. So I talked to some of the folks over there that I'm friendly with, and they helped me to create this. Now, this is a really, really powerful tool. What this does is when there are, in this case, credit spreads that a professional trader trades, and they're big ones. This is 500 contracts, 350, 459, 716 contracts. These are very big traders who are trading a lot of money. And look, if you have a job where you're a trader and you're trading tens of thousands, hundreds of thousands of dollars of somebody else's money, you're not an idiot. If you're a professional trader, you don't last very long if you're not very, very smart. So these are trades that some of the smartest people in the world are making. And I have this that shows me down to the millisecond exactly when those trades happen. And if you're nimble, in fact, even if you're not nimble, even if you're slow to the party, you can still pile on to some of these trades and trade the exact same trades that the smartest people in the world are making. Gives me a little bit of an advantage, right? So this is a trade credit spread. I'm going to start with credit spreads. And by the way, if you're not familiar with credit spreads, I do have a strategy guide on credit spreads that I'd like to share with you. So it's just simply markettaker.com/AYT. And I put that in the chat. Please go there and click on that right now. markettaker.com/AYT. And that is a strategy guide on credit spreads. If you've never heard of credit spreads, if you've heard of them, but you're not great with them, if you're pretty good with them, or even if you're really good with them, click there because there's some information, download that, and take a good look at it. In fact, if you do, there's an extra little secret bonus that we actually get you invited to an online training on credit spreads that shares exactly how all this that I'm talking about works. So please do that, marketaker.com/AYT, and get that credit spread strategy guide. Okay, so Marvel, let's take a look at this for a second. Oh, in fact, I've got to add this to my MRVL. I'm already on charts, MRVL. If we look at this stock, we've got very strong resistance by way of the 50-day moving average at $70 a share. We've also got resistance just naturally from the chart around $70 a share. We did pop through there. We peeked our head through there a couple of times, but it always came back down. We peeked our head through there pretty violently, and that was on earnings, and it sold right off after earnings. I suspect that some of the reason for that is, and let me just double check my information on this before I even say it. Hold on. Don't you like having trading tools right there at your disposal? Gosh, man, it's just such a massive advantage. Yeah. Well, I was going to say that maybe it had a high short percentage of float shorted, but it doesn't. So apparently they liked earnings going into it. This earnings actually came out after market close. So they rallied going into earnings and sold off after it. Typically, when we get a sell-off after it like this, it stays down. So the trade here was selling the March 28th. So those are the ones that expire in just a couple of days here. Today's Tuesday, right? We have expiration on Thursday this week. Selling the March 28th, 2-day to expiration, 70 calls, and buying the 75 calls for protection. So that was when the stock was at about 68. Stock's a little bit lower now. So let's analyze this trade for a second here. Selling the 70 calls, buying the 75 calls for protection. What does this mean? It means as long as Marvel stays below 70 until the end of the day, Thursday, any credit we receive on this is ours to keep. Now, I'm a big fan of closing credit spreads, or at least the short leg before expiration, to really maximize the risk reward of it. Then just once I reach the lion's share of the profit, I don't like to wait another full day to make an extra couple of pennies. To me, that doesn't make sense. So I usually close a little bit earlier. But you can make, if you made this trade, you could make up to about 51 cents. But the thing is there's dollar strikes there, and this is a $5 wide spread. So you usually do better, instead of selling the 70s and buying the 75s, you're selling the 70s and buying maybe like the 76, 77, 78 or something like that, which is what I'm a fan of, because then you end up getting what I decided to do is, when I see these really, really great trades by these really, really smart people trading really, really big money, I do a little bit of a different version of it sometimes. So I sold the 70s, but then I bought the 72s. That gives me less risk. Does it give me less reward? You would think so, because you take in a smaller credit. But the fact of the matter is I just do it on a bigger contract size. So I get the same amount of reward, but much, much less risk. So in the online training, after you download that guide on credit spreads at marketaker.com/AYT, when you watch the follow-up online training on that, you'll see that the whole process here is we take the trades from the smartest people in the world option trading, and then we proofread it and make it even better following our methodology. So we end up getting some really, really nice trades when we make those trades. So this is a credit spread trade that I really, really love. I'm going to get to Fred's. What do I end here, David? About 5-2? I don't want to go over. I know you got a great lineup today here. How can you see, I guess, who's buying or selling a particular option? We can't see, well, because we get their name and address and social security number as well. No, I'm just kidding. I mean, it doesn't matter exactly who's doing it. All we know and need to know is that it is a professional trader. Like, this is not a little old lady in pink bunny slippers in Iowa slinging 500 contracts here, right? I mean, this is a $25,000. Hold on a second. Let me get out my very sophisticated trading machine here. 506 contracts times a maximum profit of $51. Yeah, so it's almost a $26,000 profit potential trade. And hey, no offense to little old ladies in pink bunny slippers in Iowa. Maybe you do sling 500 lots. Yeah, I just need a couple minutes between presentation. Okay, awesome. Okay, cool, David. I'm always very conscious and conscientious to make sure that the next folks get to share all their important things as well. So okay, so how do you know they're professional traders and not Wall Street bets? Oh, yeah. Okay, so great question. Because on Wall Street bets, normally what that is that's a couple of hundred people somewhere in the world who are all doing 5 lots and 10 lots and 20 lots, and if they're a big shooter, maybe 25 lots. This is all one single trade, one block that all happened at the same time. This is not, and I'll tell you what, if it is one person, they're either crazy and this is going to be, probably the last trade they ever make, or they're on Wall Street bets and they're smart. Because there are some smart people on Reddit doing this. Frankly, a lot of them aren't. I read through that and there's a lot of idiots on there, but there's some smart people too. I mean, bottom line is, if there's one single person trading this big, this person is probably smart. And it's almost certain that they're a professional trader. Plus, then can be leveraged or part of verticals. Well, I mean, yeah, this is a vertical spread, right? So that's one of the trades that I really, really liked from today that is a credit spread. But somebody was asking about iron condor, so let's look at winged spread genius. Oh, there's no trades yet today in wing spread genius. Why not? Can I just, make some? No, because I don't put those trades there. Who puts those trades there? When a professional trader makes one of these trades, it pops up live real time. I have absolutely I set the criteria that I look for, and we spent a lot of time coming up with the algorithm for which exact trades to search for. But there haven't been any iron condors, iron butterflies, or broken wing versions of those yet today. That's what Wing Spread Genius searches for. Just some really, really nice credit spreads. Now, I haven't looked at this Carvana one yet today. Let's take a look at Carvana, shall we? And we're going to just research this one together. CRVNA. Wait a minute. What did I screw up? CVNA. I knew that was too many darn letters. So we look at the chart here. What do we got? This puppy's in an uptrend like nobody's business. Holy moly. That's quite an uptrend. Now, Carvana is one of those, and I'm going to go back to it here. I do have a nice little tool here that shows me the short interest. And I just want to confirm what it is. I do know that Carvana has a ton of their float shorted. Today, it's about 35%. I can actually get more accurate information. That information is the most recent that I have on this quick access page, but it's about 35% short interest. So what we tend to see is we tend to see some short squeeze type stuff happening, which actually shows up on our short squeeze scanner, but I don't want to get into that right now. We see a great deal of short-term call buying, which helps initiate the short squeeze. Although, to be fair, we see a lot of put trading here as well. So Carvana, the trade that showed up on Credit Spread Genius here is selling the 2 days to expiration 90 puts and buying the 89 puts. And I love when the strikes are very, very close together. That gives me a much more solid risk reward on credit spreads. Excuse me. So selling the 90 puts, I mean, look, man, we're only $1.88 away from the money. And earlier today, we were below that strike price. So this is a very aggressive put credit spread. What are they taking advantage of? Well, they're taking advantage of probably some overpriced implied volatility. Right now, the historical volatility is at 88, and which puts were the 90 strike puts, they're trading at almost 100 volatility. So what that means is it gives us a much greater, it gives us a greater edge, but it gives us a little bit more risk too. We're trying to make 35 cents, but we're risking 65 cents. So we really need to see this thing stay above 90. Now, that said, what a lot of people do is they'll just go in and buy calls, like, maybe the 91, or what's some popular, I mean, the 90 calls traded a great deal. In fact, we've got some more little magic tools over here. Yeah, I don't know. Yeah, we'll just stick to this. We saw a lot of these 90 calls trade, more than the open interest, so at least some of them are opening positions. But somebody bought a bunch of these 93 strike calls. Okay. Here we're risking $2.48 to make potentially a lot. I mean, if it goes up a lot, you can make a lot, right? So where I might trade 10 of these put credit spreads to make 350 bucks, risking 650 bucks, I might trade 2 of these 93 calls, risking 500 bucks to make, I don't know. I mean, how much realistically, how much higher can it get? We'll probably get about 10 bucks higher. But, I would argue that there's a great deal less risk doing it the put credit spread way, where the implied volatility is massively on your side. We could consider being even more conservative and selling a slightly lower strike, but I don't know how much good that really gives us. I mean, the support is probably established at about 87, and with 2 days until expiration, we don't get a lot for those 87 puts. That risk reward goes way down. Fred says, I'm always confused about the IV. Like here on Carvana, CVNA, right? It shows an implied volatility of 25. 25? Are you saying CVNA? Did you just miss the V? Because it's not 25. 25, it doesn't say 25 anywhere. Yeah, it doesn't say 25 anywhere. I mean, the implied volatility, it's 99. Like, you have to look at the option chain. How do I find short interest? Well, that's a whole nother can of worms to find accurate short interest. And I'm not going to do it justice giving you. I'll tell you what, Fred, just email me, dan@markettaker.com, and we can talk about this. I'm not going to have time to give you a decent explanation about it right now. Oh yeah. You can get the short interest off FinViz. Yeah, for sure. And that's accurate within a 3-week period. There's a study, whatever study you're looking at is massively wrong. Delete that study because the implied it says the implied volatility right here is 98. So Fred, that is wrong. And I do go over that well, just make sure you get that strategy guide. And we posted it earlier. You're going to have to scroll up, or maybe David can do me the favor of posting it again. It's just markettaker.com/AYT. Get that. I don't cover how to find implied volatility in the strategy guide, but I start talking about implied volatility in the follow-up online training, which you definitely want to do. So, and basically, if you download the strategy guide, I send you an email. I send you to a page on how to get that free online training. Oh, holy cow! I can't believe how much we covered today. This is crazy, man. Holy moly. This is great. When I do webinars for our group, I usually do them in a PowerPoint. I don't get to do so many questions like this. I love doing this kind of stuff, especially, and you guys are smart. You guys are really advanced. I love working with the advanced folks. Really great. Okay, what final questions can I answer? Oh, you did download. I've read up on options, and especially credit spread options, because specifically they're credit spreads. Yeah, so good, Fred, that you read up on it. Go through that follow-up online training. I don't remember if it takes you straight to that page from the strategy guide, but there is a follow-up email that invites you to it. Ben Khalifa books? Well, I don't know who that is. But just keep following through. It's really hard for me just to cram every single thing I know into one presentation like this, or one strategy guide, or even one hour online training. So just follow through the process. And I keep expanding, giving more details, because that's the only way I know how to do it. Okay. Think like an option trader, how to profit by. Okay, yeah. All right, yeah, I'm not familiar with that person, but doesn't matter. Okay, did I miss anything here? Yeah, I don't have any iron condors to show. I went through all the credit spreads that I can think of, or that I see right now. The Marvel one I like a lot. That Marvel one, once again, is MRVL. It's the 2-day options. I definitely would not want to go any further out in time than this, but it's selling the 70 calls, and I did the version where I buy the 72 or the 70. Wait a minute. Yeah, 70 calls. I sold the 72 calls, bought the 72 calls. And I like that one. I like it a lot. What's the delta on CBNA? Well, let's see here. The delta, I got short 23.8 deltas, got long 9.7 deltas, so that is 14 delta. 14 delta, but clearly more important, a 10-cent theta. Deltas are important with credit spreads, especially since this stock has been going down since I put it on, and I put it on after the original professional trader. Because usually a lot of these trades you can put on significantly later and it doesn't much matter. But the theta ends up being more important. As long as it doesn't go above 70, I'm golden. All right. So that being said, thank you for sharing your time with me. Make sure you grab that strategy guide. Thank you, David. Much appreciated. Thanks for allowing me to share some time with your group. Thank you for sharing your time with me.